The Credit Market Pulse, produced with the busy investment management, credit officer, and financial risk reporting audience in mind, is the first publication for the credit risk industry that provides a holistic overview of the health and trends of global credit capital markets, leveraging the extensive analytical intelligence and depth of data from S&P Capital IQ. I'm excited to be here with two of the authors today, Thomas Jägel and Marcel Heinrichs. Let's get kicked off. Thomas, first question for you. In the simplest of terms, tell me why this is such a cool and innovative research report.
Thanks, Dave. Actually, as far as we can tell, this is the first report published that takes a look at aggregate probability of default or risk measures across a global regional view, an index view, as well as digging in and looking at some key improvements and deteriorations by names. And we're very excited about the launch of this publication.
Great. And Marcel, let's go a little bit deeper on this. Could you tell us a little bit more about the underlying model we're using to measure this credit risk across these aggregations?
Of course. Credit Market Pulse is based on a model that we released recently called PD Model Market Signals. Market Signals leverages stock price volatility from publicly listed companies worldwide. It got calibrated on the most recent data. Such type of models are commonly known as Merton type of models. They are industry-wide, widely applied. However, we went a couple of steps ahead of industry standards. Firstly, we added various components that reflect country risk and industry risk of firms in order to have systemic risk components in the model and make the model genuinely globally applicable. Secondly, we added some techniques in order to smooth down volatility that can be interpreted as excess volatility or noise in order to avoid false alarms. So the model becomes very predictive and discriminates well between the lemons and the good companies.
Great, thanks. So Thomas, looking at the latest report here, we see that the BRIC region has a higher PD level in your analysis. Can you give us some insight on that?
Yeah, there are actually a couple interesting things about that. So that's from the first section of the report, the one that looks at the global regional trends of probability of default, and that's specifically the BRIC region that we're looking at. We actually see that the BRIC region is kind of sticky with a probability of default, a median probability of default around 2%, which is significantly higher than the other three regions, APAC, Western Europe, and North America that we looked at. I think that makes a lot of sense, especially with some of the structural problems and slightly slower GDP growth going on within countries like Brazil. One other interesting point is that we actually, when we did this section, we put a 500 million revenue cap on the companies that we looked at, because if you don't have that in there, then the risk of the North American companies is a lot higher. The North American region is a lot higher because there's a lot more micro cap type of companies that have a higher risk level.
Yeah, it makes sense. So that's great, the geographic view. Now, Marcel, turning now to more of the sector-based view, consumer discretionary within the S&P 500 looked like it was really standing out. What's going on with that?
Yeah, there's really an interesting story behind. When we analyzed the data, we found that this is based on the following. First of all, for the industry sector, we use the weights for companies that equal the weights that are used for the equity index S&P 500, such that weights change on a daily basis, and these weights are multiplied with the PDs of the individual companies that are assessed with our models. And what we found for this consumer discretionary is that JCPenney, as a company with a relatively, let's say, average market cap, had a high PD that became higher and higher over the course of the last few months, such that for the aggregate of the probability of default associated with consumer discretionary, the PD of JCPenney contributed a great deal to the overall assessment. And this is the reason why for this sector the overall creditworthiness went down quite a lot.
Well, great. Anything else you want to point out about the new report here? Biggest movers, things of that nature?
Yeah, one thing that stuck out to me in terms of biggest movers or highest PDs was the airline industry. So we saw several airlines in the highest PD section as well as in deteriorations. One standout in the opposite direction, Southwest Airlines.
Great. Marcel, any observations?
Another interesting aspect was that for the US, healthcare companies really peaked up with their probability of default. And obviously, there's a very nice story behind this with Medicare.
Great. Well, thanks a lot, gentlemen. This is very interesting, and we look forward to hearing more from the credit market polls. And thank you very much.